If you're looking to buy a property in 2024, then this video is going to break down exactly what type of loans you should be using and how you can qualify for them. Now, loans can be really tricky. It can also be, of course, very risky. So I'm going to try to talk about the loans that are some of the least riskiest with some of the best incentives for a new investor, and also has some of the lowest requirements for cash to put up front as a down payment. Now, going into it, we're going to talk about 5 very specific loan types. So if they are something that you might not be familiar with, or if you are looking for something a little bit more creative, then stick around for another video in the future as I drop a little bit more about some creative ways to finance deals. But for now, let's talk about more conventional ways. So the first out of all the loans that you want to consider, of course, is the new 5% down conventional Fannie Mae loan. Now, Fannie Mae came out with a program in November of 2023, and they basically said that the prices of homes are getting too expensive. And because they're getting too expensive and they're going to probably continue rising, what they did was they changed the terms of the down payment options for their loans. Now, one big thing to mention here is the atypical property you purchase in the United States, you'd have to put down about 20%. But if you're a citizen, permanent resident, or if you're a green card holder, you actually get the benefit of borrowing money for much less than 20% down. You can use other options, and we'll talk about those in the next coming minutes. So with the Fannie Mae 5% down loan, it's actually a great loan product. You do need a minimum credit score of at least 620 in order to qualify for the loan, but there are some really good benefits of this loan. Number one is this loan gives you the ability to borrow up to $1.4 million worth of funds, and you only have to put 5% down. So let's just say if you were to borrow $1 million, you only have to put down 5% of that, which is about, $50,000. So it's a really inexpensive, really awesome, high funding way to buy real estate. Number two on this loan is that, of course, you will have to put up that little bit of collateral, but you are technically going to be buying yourself up to 4 units with this loan. So if you're looking to buy, let's say, a duplex or a triplex or a fourplex, you put 5% down, but you get 3 doors or 4 doors, which is really nice because now you can actually make income from this property. Now, number 3, one thing to note is that this does require you to live in one of the units. So the Fannie Mae loan program requires you to owner occupy this property, which means that if you bought a 3 or 4 unit property, you would actually need to live in one of the units for a extended period of time, let's just say up to 12 months. And that intention would give it a homestead exemption on the property, meaning that your taxes would be reduced because you live in the home, because it is your primary residence. You can move out after 1 year and then go do it again. So that's totally fine. They don't require you to be there for longer than 12 months, and they don't limit how many of these loans you can take, which is really nice. However, you still need to owner occupy it through that 12-month period. What I will say is this. For the 5%, and this is just my opinion, I think it's a great deal for any new investor that's looking to buy a property, especially up to 4 units. And one of the little benefits that you get is if that property cash flows or receives some form of additional income, that income that it receives actually counts as a consideration towards the repayment of the debt. Which means, let's say you make $50,000 a year, but the property itself makes another $50,000 a year because it's a triplex. Well, now technically the lender is going to look at you as a borrower that makes up to $100,000 a year in personal income, because they're going to add the income from the property into your personal income so that you can qualify for the loan. That's fantastic. And so that's why I highly recommend that anybody that's new in real estate should go for the 5% down conventional Fannie Mae loan. Let's move on to the next loan product, and that's the 3% down FHA loan. Now, there's a lot of people that have used this loan in the past, and there's a lot of misconceptions about this loan, so I'll be very clear about it. The FHA is a first-time home buyer association loan, and basically it is for a first-time home buyer. You have to go through a home buyer program. It's something that you need to go through in order for you to learn how to buy property. But I will say this, very simple, it's very easy to go through. They give you a packet and they say, welcome to being a homeowner. Now, the property does need to get approved for FHA, so it has to be in good condition. That's number one. Number two, you need to have at least a 580 credit score, which is really low, so that's good. And you gotta have at least the down payment, which is 3% down in order to buy the property. One thing to note here is that when you use an FHA to buy a property, you're owner occupying it, you have to live in it for at least 12 months, and you are, consider this, only putting 3% down. So technically, it doesn't really cash flow if you wanted to rent it out, because the amount of debt it has is much higher than the 5% or the 10 or 15 or 20% downs that you would normally put. So because of this, that's one thing to consider if you're gonna go with an FHA. The debt ratio will be a little bit higher. Your 3% is a very low down payment. But if the numbers make sense and the deal works, then by all means, use the FHA to your advantage. You can use one of these every single year, and you can buy yourself a duplex or a triplex or a fourplex. Now, one last thing to mention that's a little bit of a plus and a minus is that every county in the United States has different FHA loan limits. So if it's in a high density area, the loan limit may be higher. If it's in a low density area, it may be lower. So you have to check the FHA limits for the type of property that you're purchasing. They give you a limit for a single door, a double door, a tri-door, or a four-door. So just be aware that you have a limit of funding. That's why in the 5% loan, it goes up to 1.4 million. But in the FHA, it could possibly go to 1 million, or it can go to 800,000. So it could have a cap, and that's something to be aware of. The next is a very unique loan, but it's also for those that have more of a builder background, or someone that wants to build something from scratch, or has a piece of land that they want to build real estate on. Now, one thing, of course, that's a big thing today is supply and demand. And so a lot of people want to build new homes in order to bring immediate equity to their pocket. Remember that when you build a property, you're building it for the cost of what that property is worth for building, so materials and labor. You're not buying it already at the value that somebody else is selling it to you for. So with a ground up construction loan, you're putting just 10% down. You do need about a 680 credit score or so it's a higher credit score, but you're only paying between the time that you get funding for the loan and the time that you complete the loan, the build. The loan also completes at that time the build completes. You're gonna be paying interest only through that period. Now, of course, one thing to mention is that when the build is done, since the loan technically completes, there's a payoff. That payoff normally means you need to either completely pay the loan balance off, or you need to refinance that loan into a new loan. Most people, what they do is they will use a ground up construction loan, and they will put 10% down and build their project. Once they finish building the project, then they will go ahead and use a refinance to, of course, not just refinance out of the previous ground up construction loan and get a better interest rate, but they will also take a cash out refinance from the new value of the property. Because if the property went up $100,000 or $200,000, then they're going to take advantage of that new forced equity in the property. How would it go up an extra $100,000 or $200,000? Well, because you built it for $300,000, but technically the neighborhood can fetch up to $500,000. So that's really the benefit of building a property from scratch. You are technically making equity come to this property the day that you complete the build, which is really, really nice, and you can take advantage of that. The next is something called a small business 504 loan, and this loan is based off of actually funding from your business. Now, you can take advantage of this loan to buy yourself an owner-occupied property. You actually have to live in this property, but you can borrow up to $5.5 million based off of the revenue that your business makes. It's gonna fully be backed by the business revenue. It's not gonna be backed by your personal income. You are gonna be the personal guarantor on it, so you will provide your credit in order to fund the loan, but you'll get a amazing interest rate for your loan. You can get a really high funded amount. You only have to put 10% down on this loan as well. And of course, you do have to owner occupy it. It cannot be used for investments, but you can technically operate your business out of this property. And by doing so, you get some really amazing tax benefits. So this 504 small business loan product is something that I would say if you're a homeowner, or if you want to be a homeowner and you also are a business owner and you want to combine those two together and get maximized benefits, this would be the right model for you. Remember, this cannot be used for investment properties. You can buy 2, 4, 6 doors, 10 doors. You can buy a big property with this loan. However, it can't be used and intended for investment. It has to be something you actually live inside of and operate your business out of. At least 51% has to be operated for your business. And the last is seller financing. And this is a creative financing solution for those that maybe have subpar credit or don't have enough down payment. This is a great way for you to take advantage of becoming the bank, or for the seller to become the bank for you. And you make your payments directly to the seller instead of the seller actually going through and getting paid off by a bank immediately. That means that for the benefit of the seller, they get to still retain ownership of the property and they get monthly payments from you as the buyer directly. But you get the benefit of technically owning the property on paper, and you also can make a much lower down payment to acquire the property. And of course, you don't really need credit in order to get this loan because it's going directly with the seller. You don't need to pay a bunch of closing fees to a bank because you're going directly with the seller. The loan is collateralized against you and your personal income, or it can be against your business. There's a lot of flexibility there, so that's really nice. They and you can really come together and make a decision on however you want to structure this loan. Typically, you'll see a loan structured about 5 years of a term, interest only throughout those 5 years. Technically, they'll structure it as a 30-year amortization schedule on this loan. So you're paying for 5 years as if it was a 30-year mortgage, and you really don't have to worry so much about your credit, but you typically put down between 1 and up to 10% down to buy the deal. Now remember, you own this property on paper, so you still have the right to refinance at any time. You can also sell it at any time. You can renovate it and sell it. You can rent it and make money off of it. There's really a lot of opportunity for you on this deal. And if you default, the seller will take back the property. That is one thing you should be aware of. But if you pay them off, they are gone off of this personal loan you have with them, and now you have it refinanced with a bank. A lot of people use this type of creative financing tool to fund a deal that maybe can't pass an insurance inspection at first. And so what they do is they fund it using seller financing and a creative financing loan, and then they fix the property up. They'll fix the roof, they'll fix the windows, they'll fix the doors, they'll fix everything on it. Then they'll go back, they'll qualify for the insurance, and then they will go in and refinance it for a new loan with a bank. They'll do a cash out refinance on it, and they'll actually use that money to maybe put as another down payment somewhere else and buy another property or start a business or do whatever they want with those funds. So these are the 5 major in 2024 loans that you could take advantage of right now as a first-time investor, and you can start buying your first, second, or even third investment property. If you like this video and you want to hear more about some of these loans in much more detail, or if you want to learn about some of the other creative financing loans that are out there that you can take advantage of, I'll be posting a couple of those videos. If not already, some of them are on my channel, so please stay tuned, like and subscribe to this video so that you can listen and learn and read and watch all the information that I share with you about real estate investing and how to get into your first investment property. All right, I will see you soon.